Joining us now to break down these jobs numbers even further, we want to bring in Steve Sosnick. He's the chief strategist at Interactive Brokers. We have Robert Sockin, the senior global economist at Citi. And Steve, let me go to you first just in terms of the market's reaction, the interpretation that we're seeing play out on Wall Street. What do you think of this print?
I think it's in line enough that the market's just going to do what it's been doing, which is continue the momentum trade. There's nothing in here to disrupt it. I think, my first reaction when I saw 227 was, wow, I was actually a bit surprised that it was this high. I'm seeing a 2-month revision to the positive side of 56,000, which is actually also a surprise. The unemployment rate, ticking up 0.1% to 4.2. It looked like the labor force participation rate fell to 62, fell a little bit. But to me, the other one that I think people aren't really focusing on too much is the monthly wage increase, 0.4%. Last I looked, if you annualize 0.4% and the prior 0.3%, that annualizes to quite a bit more than 2%. We're talking 3-4%. That doesn't help the Fed's narrative if you're on the side of hoping for rate cuts. Well, before the number, we were about a 72% chance, looking at a 72% chance of a rate cut. We'll see what the market has to say about that, because certainly Powell didn't seem to imply that either yesterday.
Well, let's talk to you about that, Robert. What are you thinking in terms of the Fed impact of this print?
Yeah, absolutely. These are all great points. And I think for the Fed, these numbers are going to be right in the spot of what they were looking for and they're comfortable with to continue easing policy, at least at the December meeting. So I would expect very much that for the Fed, this doesn't change the narrative, that likely rates are restrictive and they have to at least come down a bit more at a gradual pace. They'll be looking at some things that are concerning in the report, maybe a little bit of the uptick in the unemployment rate, a little drop in participation, but these numbers are extremely volatile month over month, and so the best thing is to kind of smooth through the last several months, especially with the volatility we've had in the reports. And the reality is we're getting an unemployment rate that's kind of staying in the low 4% range. That's sort of the definition of a soft landing. And so I think when you look over the last several reports, they'll be fairly comfortable that they're still getting that soft landing, but there are enough risks that I think they still need to lower rates.
So Robert, we shouldn't be reading too much into that slight uptick then that we are seeing in unemployment rate.
I think that, historically, what we've seen in the past is when the unemployment rate started to rise, it tends to keep going. And then when the SOM rule was set off in the summer that the unemployment rate rose more than 50 basis points relative to its prior 12-month low, people got very worried. But we've mostly been moving sideways since that period, which is very different than what we've seen in history. And so I think if we're able to stay around these levels, this would be kind of sustainable unemployment for the Fed. Now, of course, the worry is you could go higher from here. I'm watching layoffs in particular very closely for that. And when we look at the jobless claims data, layoffs are very low. And so I think right now, not a concerning figure.
What is concerning then in terms of that average hourly earnings going up, Steve? I wonder if there is an inflationary backdrop under the hood of this print.
That's exactly what concerns me, Maddie. When we think about it, the Fed's dual mandate is stable prices and full employment at a non-inflationary level. So if wages are rising. Now, let me stipulate, the idea of more people getting more money in their pockets is not a bad thing.
And maybe not a bad thing for equities, too.
Not a bad, people have money to spend, and we've had the mixed range of retail earnings where it seems like stuff like people spending money at Lululemon, but not necessarily in the dollar, in some of the dollar stores or some of the other things. So it's a bit mixed. So people having money is a good thing, but again, if the wages are going up faster than the Fed's target, that doesn't help them meet their stable prices mandate. And to Robert's point, the idea of full employment, 4.2% unemployment is a number that most administrations would have died for in some of the old days. That's a really low number by long-term historical standards. So this to me says maybe Powell was sort of leading us in the correct direction of you may or may not get 25 basis points in December. He didn't explicitly say no, but maybe curb your enthusiasm about 2025.